topics. And we've been doing this for several years, and now we want to share with you all some of the topics that we've decided are most important for financial empowerment. And today's session is about HELOCs, refis, mortgage and lending brokers, how to use these valuable tools strategically to leverage for wealth. So first thing first, a HELOC. I remember the first time I heard that phrase and not wanting to admit I didn't know what it meant, okay? All it stands for is home equity line of credit, okay? That's all it is. Sounds intimidating, but it's just a home equity line of credit. A refi is a refinancing, and then mortgage lending brokers, those are people, we'll talk about what they do. But just starting to demystify is sort of the first thing, because these are valuable tools to which many people will have access if you start to inquire about it, and you might be able to use them for your advantage. So just some interesting stats as we get right into it. Over the pandemic, some interesting things happened. There was a boom in interest in home sales. There was a boom in interest in our homes as we're living and working from home now more than ever. A lot of people looking into how do they improve where they live, where they work, live. A lot of trading going on. People were changing their homes, either improving them or refurnishing them or doing projects that they hadn't gotten around to before, or selling or buying them, especially when we were in a really low interest environment. And then there was this increase in demand for homes, and home sales started going really, really high. And then there was this interesting period that's happened just recently where there's been a bit of a cooling where supply is really low because a lot of people have just either stopped selling or the people who were going to sell have all sold. So now we still have fairly high demand, very low supply. And when that happens, you tend to end up with good pricing. So a lot of the home prices have just gotten really, really high. And if you happen to be someone who owns a home right now, you've probably experienced this. The value of your home might have doubled since the time you bought it. And the average mortgage holder in America now has at least $185K worth of equity that they're just sitting on in their home. And in 2021, this increased the most drastically, just by 48K. So almost a third of that, a little less than a third of that value was just in last year alone. So really rapid rise, okay? And then the other thing is almost half of all homeowners in the US are considered equity rich right now, meaning the mortgage left on their home is less than half the value of their home. And that also increased by 30% compared to the year 2020. So just we're in an exact moment in time where if you do happen to own a home, you're probably very equity rich due to these various factors. Now, another thing that's really interesting is mortgage rates, like all interest rates, have been historically low. So if you look at what rates were back in the 80s, we're talking 17% rates on home mortgages, and then a steady decline, you can see, where it's gotten lower and lower and lower to where, and some of you might have been familiar with this, you know, we were in 2 and 3% interest rate areas. And then in 2021, it got even more crazy low, almost to the floor of what's possible as far as an interest rate, right? So you can look at this trend, and then you can see that because we know that there's inflation and we've had to finally start increasing interest rates because we're trying to resuscitate the economy, interest rates are starting to go back up. So see this big pink arrow, this is the inflection point we're in right now, where we got basically as low as you can possibly get on interest rates, ridiculously low in comparison to where things used to be back in the 70s, 80s. And now they are going to start to go back up. But what was really interesting was that these low interest rates were part of what was helping so much with gaining all that equity that's been going on. Because if you were able to do a refi, and maybe you'd bought your home in 2008 like I did, and back then the interest rate might have been around 4 or something. But then you were able to do a refi when things were dipping down into the 2s and 3s. Then you could refinance what was left on your home mortgage and put yourself in a good position and pay more down towards the equity. And meanwhile, the value of the home has been going up, so you're in an equity rich position. So I did mention about refinancing. I heard through a friend, right, that it was a good time to refi. The idea hadn't even occurred to me until another friend of mine said, oh, we just refinanced our home. And I thought, oh my gosh, you're right. Interest rates have been going down. I wonder if I could do better than what I got when we first bought our home. I think the interest rate at that time was something, like I said, maybe 4.5. I don't know, 4.75. We bought in 2010. And so the first time I refied, I think I went to my bank. Okay. And I saved a little bit. I shaved a couple points off. Maybe I went through the whole thing. It's just like requalifying for a loan. But it helped because I was able to bring down what my mortgage payment was, and most importantly, bring down my interest rate on this giant loan, right? You're talking about loans for hundreds of thousands of dollars. So even just a couple points on your interest rate really matter in the long run. And then I actually got a little better at this. I learned what a mortgage broker is. So I'd heard of mortgage brokers, but had never really connected for me until I owned a home. And then I was shopping interest rates. And then I thought, oh, okay. A mortgage broker is somebody who basically specializes in people who want to refinance debt. And they're able to work with all kinds of different institutions to tee up candidates and then get you interest rates that might be a little bit more competitive. And they're your advocate because they're looking to create business. That's how they get paid, right? They get their fees when this deal closes. And so if you find a good mortgage broker, and trust me, there are many of them out there, you might even be able to do better on any refinancing that you're looking to do than you might be able to do with your own bank. Now, it depends, but it's important to learn what a mortgage broker is, because while some of this might seem really obvious and basic to some people, okay, it's not obvious to everyone. And we want to make sure that it starts to be obvious to every single person. Every single person who owns a home should know what a mortgage broker is and should be able to have access to a really good mortgage broker. So that's mission one. If we're having a mission with today's presentation, it's to understand what a mortgage broker is. Now, again, when you go buy your first home, or you're maybe starting to learn about refinancing, it's natural to go to your bank. Or sometimes there are online vendors like Rocket Loans. You've seen a lot of advertisements and stuff. That's natural too. But it's good to know that's not your only option, because the mortgage brokers are competing for your business. So they can be friendlier. If you've gone to a bank, sometimes they're just very cold. They just don't really care. They're a large institution, versus a mortgage broker who's just one person. He or she is, working overtime to try to get this deal going. They're really on your side. And you can be, you can share sort of inside information with them too. You can say to them, sort of, look, here's my situation. What's my best strategy here? And they can help you strategize. Some of them really specialize in understanding unique income models. So for example, at Quantum, I have a lot of clients who are in the entertainment industry. And entertainment clients tend to be paid in unique ways because they might have an S Corp here, or they might have certain kinds of contracts or deals, but they're not paid necessarily always as a W-2 employee. And if you're going to a bank, or if you're going to some of those traditional institutions, sometimes the bank just doesn't even know what to do with it. They're just like, well, you know what? I don't get this, or this doesn't fit into our cookie cutter parameters. But there are mortgage brokers who actually specialize in helping people who have self-employed income, for example, or maybe hybrid situations. And that's really good, because that affects your underwriting, and that can affect whether you get approved, and if so, how good of a rate you get approved for. So you want people who are able to handle the nuances of your circumstances. As I said, they're on your side. They win when you win. So you always like win-win situations, right? And then another thing is you can even negotiate with them. So this was one of those mind-blowing concepts, I think, for me when I first was starting to get into business a little bit more in a mature way. The concept that what they offer you, you don't even have to just take at face value. You can actually say to them, hey, you know what? No, I want you to bake the closing costs into this for me. I don't want to have to pay anything. Or no, can't you do any better than that? Or I'm going to a different broker. Because there's usually somewhere in there, some wiggle room even on their end, that they're manipulating a little so that they can get a deal. And the idea is you have to think of yourself as being in charge. And you're having hundreds of thousands of dollars of opportunity that they're looking to win. So being in the pole position, I guess, of calling the shots is something that you have to try to start thinking about too, if you really want to get good rates. So I know a good mortgage broker out of Philadelphia that one of my really savvy friends told me about. Okay. And he's pretty great. And the good thing is, I also know other mortgage brokers now. So if I go to this one mortgage broker and I feel like he's not really coming through or I'm not loving it, I can say, well, no, I want a little better than that. Can you do it, or else I'm going somewhere else? And the ability to kind of walk away also creates leverage and arbitrage versus, think about it. If you're going to the bank, you sit down and you take what they get, or you take what they give you or nothing, and it's checkmate. This is a whole different situation where you're able to pit people against each other and negotiate for yourself. As I'm talking about this topic by topic, if questions come up about mortgage brokers, I would really love if you guys could ask, because I'm not here to just kind of at people about this. I'm going to share information, but if any of it is new information, I'd love for people to ask as we go. And of course, at the end, we'll also have Q&A, so we can circle back on some of this. And again, some of you might already know what a mortgage broker is, but I really do encourage people to ask questions about this. And when it comes to the best way to find one, like I said, just ask around. You'd be surprised. Once you know to look for one, it's not that hard to find a good mortgage broker or get names for several of them. Okay, so once you know how you can get access to different interest rates from what you may have currently. Okay, so step one is learning how to actually navigate the market and know that you're not stuck with the one loan vendor that you might have first gotten. It's also a mental game of learning how to come up for air and assess your debt periodically, because interest rates are always changing, your situation is changing. So right now, interest rates are rising, okay? A year or two ago, interest rates were falling. So when they were falling, that was a great time to say, oh, I'm noticing or hearing on the news that interest rates are falling. Oh, and then you make the mental connection and you say, well, maybe I could shop some debt right now. Maybe there's a refi that I could do right now on my home that's going to save me money. And those are the moments where you want to seize the opportunity and get access to a good mortgage broker and see. Right now, while interest rates are rising, it doesn't mean there's not opportunity, but I would say this is another inflection window where it's time to think quickly and move quickly. So you can check in and see, for example, are you still sitting on outdated interest in your portfolio? Did you not refi over the last 4 years or 5 years? If not, jump on it, because you might still be able to do a little bit better than what you did when you first bought that house in 2010 or 2014. And the window's kind of shortening quickly. So if you haven't, jump on it right away.
Yeah. So Jennifer, just real quick, I just wanted to jump in and also say, like, when you're shopping, like, in addition to the mortgage brokers, I always like to go in very informed when I'm speaking to any professional. And so a way that you can do this online is that you can go to sites like Lending Tree. So these are aggregator sites that are kind of like mortgage brokers, but like online mortgage brokers. And so you can go to a lendingtree.com, or, if you go to Bankrate or even NerdWallet, like some of these sites, like what they do is that you can plug in the information for what you're looking for. You can play with the mortgage calculator. And then if you opt in, just be prepared. If you opt in to see the rates, you're going to get flooded with emails from a variety of lenders, because it's an aggregator site, and those lenders will compete for your mortgage. So you can check which ones have the best rates before you, before you hit go, basically. But what's really helpful about this is that you can see what the different rates are, the stated rates, and then you can have different conversations with different lenders as well. Should you not have a broker, but I always find it really helpful to go to those sites and to see what the prevailing rates are and see how they compete, because 70% of mortgages are issued by non-bank lenders. So not banks. but just like very large lenders, and they sell off their mortgages to the same place. But that's like a whole new line of business, is these non-bank lenders. And so they will always have lower rates than the banks unless a bank has a special rate, which is not a bad idea to ask about at your bank if they do have special rates, because they do in certain communities, they have certain programs out there. So it's always a good idea to ask your bank, especially if you have a relationship at your bank with a banker, which is something we've talked about a lot, is having those relationships. But otherwise, the non-bank lenders will usually come in a lot lower. And also your realtor will have lending contacts that they use consistently. And those are all non-bank lenders. So those are some other sources to look for and to compare rates.
That's awesome. Thank you, Adipia. Yeah, absolutely. I appreciate you adding all that color in those stats. And I will say, even if you go online to like a lending tree or something, don't let that stop you, because even those might not be as specific to your situation as if you get a personal referral who's able to really understand your situation. So be a little persistent about it. There's so much opportunity out there. Think of it as this giant mall that you get to go through until you can really find whatever that best interest rate for you might be. Another thing that also might have changed since the last time you refinanced any debt is your credit score. So interestingly, even things like a hard inquiry could really change your credit score by somewhat significantly, even up as much as say 40 points for someone who has really good credit, but you might have a couple hard inquiries for some reason, and then it drops from, let's say, an 800 down to a 760. And so depending on the timing of where your credit score happened to be, because it does naturally fluctuate, and whenever your last loan was done, your credit score might be different. If you happen to see that you've really done a lot of improvement on your credit, or it happens to be really high, and it may not have been as high as the last time, then that might be another factor that's changed that might impact what sort of interest rate you'd be able to get. Another is your debt to income ratio. So debt to income ratios are what especially impacts the loans. And your raise more recently, right? Or different things that might have changed in your financial situation that you just didn't put two and two together about. So maybe there was a car that you were holding a loan on, but then it turns out, oh wait, we paid that one off. Or we sold that car, now we're down to one car as a family, or whatever it could be. Or yeah, I got that big new job and I haven't even thought about that. So things might have changed in your personal situation that would have been impacting the kind of rates you could qualify for. So do that mental check-in. And then the last one to really think about is what kind of loan you took. So maybe you took a 30-year term, which is advisable, in my opinion. I really prefer really stable loans. However, you can ask yourself, do I really need that 30-year? Because sometimes if you're taking a lower term length, you might be able to get a slightly better rate, and something might have changed. So for example, if you know that you're going to sell this home as soon as the kids go to college and they're like 16, right? And you're still in a 30-year loan, and maybe you're able to do a 10 and a 15, something that you know for sure is still going to work for your needs, you might be able to refi around that factor. So it's just trying to think critically and a little bit more strategically rather than just being in your mortgage, kind of looking at your mortgage. Those are different things to be asking yourself, because they're not going to know these factors, but you will, especially now that you've learned these things. So yeah, these are topics we could go on about, but we're just trying to sort of stay as much as we can at basics for now, so you start getting concepts.
And Jennifer, just really quick before we start to talk about HELOCs, Kathleen mentioned that you can pay down your mortgage faster. Like once you've locked in your mortgage payment, that is the equivalent of your principal and interest, you can choose to make a bigger mortgage payment. You can't make a smaller payment because it has to time out to 30 years. But you can make a bigger payment. And so if you choose to make a bigger payment toward your mortgage, then you're paying your principal down faster, which shortens the time of the loan. And just in general, just really quick note, as we're going into a rising rate environment, there is an expectation that the Fed may raise rates by as much as 75 basis points today, which is a lot. Possibly another 75 in July and another 50 in September. So we're definitely entering a much higher rate environment than we've been used to for the past few years. So if you're in a situation where you are getting a mortgage, or even a HELOC, but those are variable. Usually, and I was shopping for a small mortgage here on a property recently, and what it came down to was you're just going to have to, get this like higher rate now and then refi later. So this is the concept, right? Like if you're in a situation now where you have to buy and the rates are what they are, you can always refi later. And so that also reminds me too, and we're not really talking about home buying, but it is top of mind for a lot of people, is that if you can lock in your rate with your lender, which is helpful in a rising rate environment, right? Like I locked in a rate while I was going through the process. So today's interest rate increase doesn't affect me because I have last month's rate because I locked it in. So those are conversations to have with the lender. And so that you can protect yourself from further increasing rates if it's going to take you a while to close on that property. And today, yeah, Kathleen, definitely today is a good time to go fixed rate. No 7/1 ARMs. Like there's an expectation potentially that, in a couple of years that interest rates will start coming down a little bit. There's this moment right now in economics where the Fed is using interest rates to try to tame inflation and demand destruction. So we'll see if it works. So far it's not working, but it will have an impact, and it will have an impact on a cooling housing market. So all good things to keep in mind when you think about the complexities and all the different pieces that go into making a purchase and getting a mortgage. So you can always refi later, and it's actually a good idea to do so when interest rates go down. Always pay down your highest interest debt first. All right.
Yes, absolutely. And I have a question. Is it ever a good idea to get a 7/1 ARM? I feel like no. I feel like, is it ever? I'm really curious. When and if is it ever actually a good idea? I'm just such not a fan of variable.
It's a good idea if you think that over the long term that rates will come down.
But okay.
But then you're like
crystal ball.
Then your crystal ball. Yeah, your crystal ball. And so, and a lot of times like variable rate is actually used in commercial real estate a lot more than it is in residential real estate. Because it's just like a totally different, thing. It's a variable rate mortgage, Kathy. So it's like a 7-year or a 5-year term that's variable. And so it also works in a lower rate environment or in an expecting to be lower rate environment when you also think you're going to sell your home. Because the reality is that most people don't live in their homes for 30 years, right? The reason we do a 30-year mortgage is because we want our mortgage payments to be lower. So by doing these variable, the adjustable rate mortgage is what ARM means. So what we do with those is if you know that you're going to sell it, then you do a shorter term, you do a variable rate mortgage. Generally speaking, there aren't prepayment penalties in the US for mortgages. There still are in Canada. I know I had to pay one when I sold a property and it was really annoying and expensive. And so also ask about that, right? Like there's all kinds of penalties and fees and like that you got to ask about. But in the variable rate, that works not in this environment, unless you have like a big stomach of steel and like you're waiting to see what happens in 5 to 7 years. But at this rate, like the volatility in markets and what's going on is just like too much. Like it's just it's much safer if you have to get a mortgage right now and you have to pay the rate that you're paying. It is what it is. You can always refi later. The important thing, like we talked about in the last slide, was that your debt to income ratio, and I talked about this last month too, that you're not overextending, that you're not like hitting your max limit on your debt to income. You got to keep it like safe if possible. And so the other thing is, Amy mentioned you got a HELOC last year. Yeah. So we're going to talk about that now. Generally speaking, HELOCs are prime minus, and that's why we love HELOCs. So I'll let Jennifer continue with that. So we'll get into it.
Yeah, and I'm just going to add my own opinion is with a mortgage, predictability is a very helpful tool. And there's lots of other places you can take on risk. There are so many other areas you can put your money at risk consciously in order to take on upside growth. And I'm a huge fan of stability where you can have it as your foundation for where you're able to take on higher risk at higher reward. So I just want to say a lot of people have gotten burned trying to use these kind of variable rates, especially on personal property, and don't fall for it. And that's the other thing. If you're working with a good mortgage broker, hopefully they're sophisticated enough to know what would be a good bet and what wouldn't be, and to say, like, I'm only going to show you the ones that really make sense. I'm only going to show you stuff where there's no prepay penalty. I'm only going to show you stuff that's going to make sense, because they're bringing you the creme de la creme of opportunities as a sophisticated lender to a sophisticated borrower. But yes, thank you for putting those caveats out there, Adipia. There are all kinds of little tricks, and you don't want to get into any of those situations. So just do read the fine print and ask. Okay, so we're going to switch to HELOCs just so that we make sure we cover those as well on this call. So remember we talked about this high equity environment where people who have been fortunate enough to have homes are sitting on equity. I'm going to try to explain how that concept works. So if you think about, you got a house and maybe it was 800K and you bought it in 2010. And maybe back then you were able to just put 10% down. And so you financed 720K, right? And you were paying it at whatever interest rate. Now the house has doubled in value. It's worth 1.6 just because home prices have risen. It's not like you did any major improvements or anything, right? And you've been paying down steadily on that mortgage. So let's say by now you owe about 680K. All of a sudden, the ratio between what you owe and the total pie, right? So look at this whole circle. That would be the home value. Your circle is partly financed by debt, and the rest of it is just home value that increased, right? And so suddenly you owe, instead of, let's call that 80 or 90% on the value of the home, you owe less than half on this home. Cool, right? So what happens is the bank says, well, if they were to default, I would be in a great position because I would get the house. So then they're willing to let you finance part of this equity and set it up as a home equity line of credit. Now, there are other tools you can use to also get access to some of that equity, but I'm focusing on HELOCs just because I like them. And I think that they make a lot of sense because there's some flexibility in them, which I think is really nice. So hopefully people get this concept now, if they didn't before. The thing about the HELOC that I love is it lets you sort of be your own banker, because what you're going to do is you're going to go to the bank and say, hey, I want to get a home equity line of credit. And then they're going to say to you, okay, if we were in the scenario I just painted, they might say, okay, you've qualified because your credit score is great. You've done really well on the mortgage payments. You can get up to 250K on a line of credit. And then it's going to basically be approved, but you don't have to touch it and you don't have to pay interest on it until if and when you touch it. And then you decide when and if you're going to touch that money. And the interest rate, as Adipia said, is typically going to be whatever the prime rate is, hopefully minus a little bit, a point or two. So it will not be locked in, okay, which sounds like it's contradicting what I said about mortgages. But I think in this case, it's okay because, A, you're not locked into payments. You're only locked into interest if and when you're leveraging and deploying that money. It's not like a mortgage, which you're going to pay every month, okay? And if you are leveraging that money, you're using it strategically for a reason and with a plan. And you're going to be thinking of it in the context of what are the other interest rates at play here. So, for example, let's say you want to do improvements on the home. You work from home, and so now you want to build out an addition so you can have a home office, okay? Well, you could try to pay for it with savings that you have, right? Or you could theoretically use the use the HELOC to finance this project of yours and pay yourself back and decide, well, that's great, because rather than having to spend all 60 or 80 or 120,000, I don't know what it costs to do an addition. I haven't done one on my home, probably a lot. But you could denude yourself of all that capital all at once, or you could finance this and keep access to some of your other capital for other projects, maybe other investment opportunities, maybe other things that you want to do. So you're thinking strategically, pros and cons of where you can access different buckets of money. And you're really in charge because you've got the line of credit approved. So you're the one deciding when and if to touch it. So that's really convenient. In a way, it's like you become your own Shark Tank and your own investor. You ask yourself, okay, is it worth touching this money? What for? What is it going to get me if I do it? And you make the call. And of course, with that comes great responsibility. If it's to go buy, I don't know, some really cool clothes, is that really the best way to go? Is it worth the interest that you're going to take on, et cetera? Maybe not. But even that, let's say you have a business and you're going to go do a lot of social media work and your wardrobe really needs enhancing. And you're like, no, I'm hiring a stylist and I am developing my wardrobe out and I'm doing it for this reason. And I know that if I do that, I'm going to get a 10x return because it's going to be part of my biz dev strategy. And then you're financing it. That's a different story because there's a plan and there's an expected ROI on what you chose to do with that money. So just a different way of thinking.
And Jennifer, just real quick, just on that note, like what you were saying, I thought, I wonder if you can kind of write all of that off. So I would speak to an accountant. I would speak to my accountant in conjunction or my business manager just to see, like, can I write that all off if I'm going to put in, I'm going to spend $20,000 because this is part of my marketing budget, or it's not CapEx. It's not like traditional assets that you can depreciate, but it is an expense. So I'm personally just saying, like, I'd be curious to ask my accountant, like, how does that work? Like, how do we write that off? Like when you're using your money strategically, then it's always a good idea to have those conversations with our other professionals. And then from a real estate perspective, an idea is, now I live in California and there's definitely a housing shortage, especially affordable housing. And they've changed the laws whereby now you can convert a lot of single family lots into multifamily. So like maybe max 4 unit, and also laws around ADUs, accessory dwelling units. And there's somebody here on the call that's a design build person as well. And so something that I would do, and I actually am going to do it, is on land that I have around my home is I'm going to put in an income producing unit. And that way my home turns into an income producing asset and not a liability, because it really is if it's not producing income. So that's a really good way to use a HELOC, is to use it to create an income source, which in and of itself ends up paying back the HELOC, right? So things like that, and or converting your garage, which is what I did in my first home. We converted the garage into an Airbnb, and that was all financed through the HELOC essentially. So those are some a couple of different ideas too when you're really thinking strategically. And it also brings us to the added tax benefits, which Jennifer, I can take it because I'm kind of on it too, is that if you're using your HELOC for home renovation, you can write off that interest. You can't write it off if you use it to buy a car. So you have to keep the accounting of it, technically, but you can write off the interest to do home improvements. And so that's a great thing. So HELOCs are also a tax benefit, because here in the US, there's a limit, but it's still a lot, is like we can write off up to $750,000 of mortgage debt, which includes HELOCs.
Yeah, it's fantastic, right? Think of that triple win-win. And just a little side note, you need a good accountant if you don't have one. If you're going to start playing this way with your money, you need a good accountant, someone who's able to have the conversations at that high level of, oh, what creativity, what legal creativity is there in terms of opportunities, advantages, and structures. So just a side note, I know so many sophisticated businesswomen who are using like the accountant they inherited from their dad, and it's sad to see, because you're just leaving so much money on the table and you work so hard, and then you're just chopping yourself up at the feet to not have strategy on your side with these big pieces of the puzzle. So yeah, just going back to that purple slide here, just thinking through it, right? There's a lot of ways in which you can be leveraging for efficiency. As Althea said, definitely income and tenant units. That's so smart if you can do it. Even stuff like, there's these cool sites now where if you have an extra unit and then you can do home exchanges, so you can start having extra space that you're able to swap and use for vacations. There's just so many ways you can get creative about that. Let's say you've been paying for office space, and I used to do that. I used to spend more on office space for Quantum than I spent on my own home mortgage, right? Now, with people working remotely, I've been able to downsize Quantum's office space. I still have some, but I don't have to spend nearly as much. But maybe if you're in a similar situation, you could say, wait, why am I doing this? Why don't I just build a home office out, a unit in my home, if you're able to do that? Efficiencies like solar, AC, heating, getting solar installations, whatever, all the stuff, irrigation, landscaping, so that you can cut down on your water bills and you're beautifying your home and other things. And then also, of course, necessary repairs. Oh, go ahead.
Yeah, also, Jennifer, some of these things too, really important. Again, must ask CPA. But depending on what you do, especially if you're doing an addition or like you're doing a big renovation, when you undertake a big renovation, you are increasing the capital base of what you paid. So you want to, do it with licensed, bonded contractors that give you receipts, and keep your receipts and keep really close track of this stuff, because you don't get to write it off, but you do get to add it to the cost of your home. It's called cost basis, so that when you go to sell it, you are actually paying less tax, because what it costs you to buy or renovate the property went up. And so the difference between, let's say, like your purchase, like your sale price up here and your purchase price is here. But if you spent money, then your purchase price sort of is here. And so you only pay tax on this. So you get it back later.
That's such
not
a good
everything.
point.
Yeah, not everything counts in that, but that's another really good, like I keep all my receipts and I don't get to write off, I can say everything, but I keep them all because, that's the whole point, is I made these, capital, it's a capital expenditure that added to the cost basis. I just want to throw that in.
Keep every receipt. I remember I had a summer job once where I just literally calculated totals of every receipt this couple had used or kept for their home in the valley in Sherman Oaks that they were selling. And I had to tally so they could get all of it to offset the capital gains when they were selling that house. And I learned a lot from doing that. I was just like, wow, not everybody knows this. And they were very savvy, so they did know it. It's huge because it really offsets your capital gains. Okay, so, and then this is in light, because this is very, for those who are high risk tolerance, really know what they're doing, okay? It's not for everybody. But if you have access to equity in your home and you don't have a lot of other liquid, because maybe just to get your home, you had to really go all in, and you have access to line of credit, and you also have access to very high yield investment opportunities that you know about. We're not talking about the stock market right now. We're talking about syndicated real estate opportunities, for example, that have an amazing track record, or venture capital opportunities that you really have vetted and you're really feeling strong about. You might be able to free up liquid that you're paying interest at, say, a 4% rate. And if you expect that you're going to be able to get 12, 17, 20% out of this investment, you can make a strategic decision about whether you want to deploy any of that equity into investment opportunities, right? Or looking at other high interest debt that you have where maybe you're paying a ridiculous rate, 6%, 7%, 18%, and then wait, your HELOC is at a 4%. If you're able to do stuff to consolidate your debt, those are strategic, and you have to be really careful about that, and you have to really know what you're doing. But so I'm not going to harp on that because I think we're starting right now here at basics, but it's just ways of thinking, really starting to open the paradigms. I'm going to share a story because I have a dear friend. She went to Princeton with me. She's brilliant. Okay. And her brother and she inherited her mother's home when her mother went into long-term care. So here's my brilliant friend. She's the breadwinner for her family. Her brother and she had a disagreement about what they should do with the property. She wanted to do repairs and he wanted to do repairs, but she wanted to do them nicely and make it really beautiful. He was like, no, just get it functional. Anyway, she's now paying for all the repairs at her own expense because they disagreed. And so she's doing it her way and she's spending a fortune on this renovation for this home. Eventually, they're going to rent the home out. No one's living in it anymore. Okay. But even my brilliant friend who goes to Princeton, who's in business, didn't think about possibly getting a HELOC on that property and financing those repairs instead of fighting with her brother and being like, fine, I'll pay for it myself. Now she's eating up all her liquid and she's grumbling about that, right? They could have gotten a HELOC potentially, financed the repairs, knowing that those will be paid back as soon as they rent out that income. Argument solved, number one, and her own liquid is not tied up. And then now there's the opportunity cost that most of her liquid is going into those repairs instead of investing in her own future, in her own retirement assets, in her own potential other investment opportunities, right? Because she's just not thinking strategically about it. And that's why we're doing this webinar, because look how much of a difference that makes in your life. That's why this stuff's important. Somebody asked a really great question, which was about whether we do, if you guys want any information about advisors, really good accountants, really good mortgage brokers, please just email me or Adapia. Please feel free. I'll put my email in the chat. I'm more than happy to connect you to any of these resources. And I'm blessed to have a lot of great resources because we're in LA and there are a lot of financially savvy people and just due to the nature of what I do. So I'd be more than happy. Please reach out. Okay. So a couple things. This is all about leverage, right? First of all, interest rates are going up for sure. And I have my own thoughts about whether I think they'll ever come back down, okay, in the short term. And that nobody knows. You literally need a crystal ball and nobody has that.
No.
But what we do know is they're going up right this second. And so if you know you're sitting on an opportunity here where you're in an inflated rate that you could do better with for all the reasons we discussed, get on it. Do it today. Like, I'm not literally even kidding. Do it today. These are time-sensitive moves for you to be making. Another thing is, think about this. Inflation is going to increase and keep going, even if interest rates don't, right? We know that inflation is kind of here to stay for the foreseeable future. So if there's a project that you did need to do and you need to do it anyway, but you've been putting it off and you're thinking, well, maybe we'll do it next year. Think about this. It might cost 20 or 30% more next year than it might cost today. So if you're able to leverage into action today while the costs for certain things are lower, that could actually help you in the big picture of your finances. So I know that's a little bit of an abstruse concept, but just thinking about the time of inflation on costs, and if you can get a HELOC, for example, to finally move on something that's been on your bucket list, doing it now might help you on the macro. The HELOC rates are also probably going to go up because right now they're based on prime, which is low. Prime will go up. Yeah. But if there's a window you're sitting on, again, action. And then, inertia and opportunity cost. So, we found that, especially for women, but I think for everybody, actually making these kinds of moves are scary. It's intimidating. So we tend to do nothing. We tend to just sit there frozen because we're just afraid of getting it wrong. And remember, there's actually real cost to that. So while you're afraid of losing, making the wrong move, making a mistake, you're actually also losing sometimes by being frozen in fear. And sometimes that can help you move into action to know, well, actually, I'm losing either way. So maybe I should just take that little risk, get into, try this out, do the best I can. It's okay to make mistakes. So doing nothing also has a cost. And you just want to be continuously kind of scanning through all your debts and looking and saying, hey, can I fine tune this one? Can I pay this one off faster because things have changed? Can I move access to money in different buckets around? At evaluating the interest rates and the access that you have. So how are we doing for time?
We have about 6 minutes.
Okay, perfect. Okay, so why don't we open to some questions if we have any?
I have a question.
Hi.
Hello, how are you?
Good. How are you?
Doing well, thank you. I actually just got a call when you were talking about working from home and you can build an income producing ADU.
Mhm.
I just got a call from somebody that was saying they wanted to do the exact same thing. However, they had already taken out too much equity on their home to pay for their kids' education. So I was wondering, are there any other options what would you do in that situation? What would you suggest how they maneuver in that situation?
Would this be your client?
It was a potential client.
Got it. I mean, honestly, like right now, I wouldn't try to put more debt on a home because so many homes are valued very highly. Whether that's overvalued or not, I don't know, but there is a possibility in a slowing market that values come down. So if they try to take out more equity, then they might be underwater, which is where your loan is worth more than the value of your home, and the value is set by the market. So it's a moving target. So I'm always looking at the downside scenario and protecting myself from that. So that's the risk management. So the worst case is that they put too much debt and then the bank takes their home, right? And so the only other way that they could do that, but again, it adds to their overall debt load, would be to go to a hard money lender, some kind of external real estate investment lender, or there potentially some companies, I don't know. I mean, I know some companies that do ADUs, but I don't know if they have their own financing arm. Like that's something that started to happen in the past few years where they would have their own kind of financing to allow it to happen, right? Because debt makes the world go round, literally. And so without credit, we're not doing anything. So that my first instinct would be a hard money lender if they lend on ADUs, but they would have to put a lien on the whole property. So I'm not really sure if they're already over levered, then they just have to pay down that debt. They have to find some other money.
That's what I would say. Yeah, I agree with you. I think these are great questions. And this is exactly what you want to be doing, is evaluating. I would say, no, danger, Robinson, like do not over leverage the home. Too much bad happens. But here's other ways you get creative, right? You acknowledge the fact that that was a priority, the education was a priority. And so there's debt there. And then you can look creatively at what can you do. So there's a site that you can actually go to, and it's like 100 ways to start a side hustle. And seeing what you can do to increase revenue, right? There's so many different little ways you can increase revenue, and that could start to pay down that debt faster to put you in a position to do the ADO sooner. Or, for example, the kids, if they potentially can qualify for scholarships. Like I literally, I'm a nerd, but like my senior year, I spent every Friday night applying to scholarships, and I ended up having basically my entire education covered with scholarships. Like, if you really are serious about creating more money, it's usually there. It just takes a little bit of creativity. It's not going to like fall in our lap, but if you decide that you want to go after it, there's a lot more resources. Their top priority right now would be create more liquid to make up for what they invested in the education. I get it. I've been there myself. And I was in a very similar situation, and my solution has just been create more liquid. And then more things become possible again. But that's possible to do. You just have to start thinking about it. But you don't want to create more debt. Not in my opinion. Not there.
Thank you.
Yeah. Title locks. No, I've never heard of that before either.
Yeah.
Interesting.
Yeah, I mean, I know that title is, I mean, it's so that somebody, yeah, actually, I've never heard of that. I'm thinking of a lien, not a title. So yeah, I'm sorry, I don't know about that, Kathleen.
Is it to prevent somebody from taking a HELOC out on a home that you don't want them to leverage? Is that what that is?
Yes, that's what I understand. I understand it's kind of like freezing your credit, so no one can take out a loan in your name. So I don't know if this is I've heard a lot about it recently advertised, and I didn't know if it was something that was, very valid, or is just another way for some service to get money from you on a monthly basis.
I mean,
yeah, it sounds
seems
like the latter.
Yeah, I had someone try to take a loan out on a property that I was named on as a trustee, and they could not do it. And they were annoyed, but they could not do it. I don't think it's that easy to take a loan out on someone's property without your knowing.
No.
Especially if you've got a
Can I
first
jump in for a sec?
holder on it. Yeah.
Oh yeah.
There have been cases where people have literally stolen the title out from underneath other people that own a property, even while they're living on that property. And I think that's the title lock that Kathleen is talking about. So not necessarily putting a loan on it, but literally can steal the title right out from under you.
Wow.
Which it's bizarre that they can get away with, but it has become another way that people are literally fraudulently stealing from people, literally steal your home right out from under you.
Okay, well then maybe it's worth it if it doesn't cost too much money. I don't know, $15 a month max is what I would pay for that. But
I have heard that just by putting a HELOC against a property, so there is some kind of something against it, can stop that title theft.
Oh, wow.
So even just by having something in place against a title just adds one more step to get in the way of someone stealing your title. So add a HELOC.
Wow.
Thanks, Kathy.
Yeah, thank you. And that takes me to our perfect way to kind of close this. That is exactly the value of these brass tacks discussions. Thank you, ladies, for participating. We don't know all the answers at all. We're just committed to discourse and growing and getting information and sharing it comfortably and knowing that we don't know, and that being okay. I'm telling you, there's not a single man or woman out there who knows everything. They couldn't possibly. So getting rid of that embarrassment, that feeling of, oh, I should know this, or someone knows this better than me, is the exact point of what we're doing. Adipia and I have co-founded an organization called WOW, which stands for Women of Wealth. We welcome you to go to our website, womenofwealth.com. It's WOMXN of wealth.com, and learn about what we're doing. But what we're really committed to is brass tacks financial conversations around money, because women are going to be in charge of quite a bit of money and already are. And it's time for us to seize that control. So these are some of our tenets. And again, we're very thankful to everybody who joined us today. Adipia, did you want to say anything in closing?